This trade lasted 2 hours and 45 minutes, and it lost. Not because I broke my rules, not because I forced a trade, and not because the setup was bad. In fact, this trade met every rule in my system. The location was correct, the pattern was there, and I waited for confirmation. So the real question is, why did it fail? Let's break down. Because this type of trade, it's one every trader eventually has to face. This is PLTR on the 1 minute chart. The red line here is the high of some previous day back then. So levels like this matter because they represent memory in the market. Traders remember them. Institutions defend them. And price often reacts when it gets there again. But levels alone don't create trades. What matters is structure. So on this channel, I repeat something simple. Location plus pattern equals structure. Because patterns by themselves are meaningless. A flag in the middle of nowhere, random. But a flag forming under resistance, now it becomes something different. Now it becomes a setup. So the market opens down here and moves up towards this high here, broke the high, and then breaks back under the high again. So as price moved under this level here, something started forming. A bear flag. You can see clearly price tests the top here. When test the top, reject, test the top, reject. So it then a third time, so 3 times it touches here. So this creates pressure in this area here. Buyers pushing towards and sellers holding the level. And when price compresses like this, the market is basically building pressure. Pressure usually resolves with the breakout, or in this case, a breakdown. Now, here's the part that matters. I didn't enter inside the pattern. A lot of traders do that. They anticipate the move. They try to predict what the market will do. But anticipation often leads to bad trades. So I waited for confirmation. And then the confirmation came with this full red candle, this full range red candle bar here, closed outside the structure. That was the signal. Location plus the pattern, the break equals structure. Everything aligned. So I entered the trade. The stop was above here. My target was down here. A clean, rule-based trade. But here's where things get interesting. Because there's something subtle in this chart. Something most traders completely miss. And it explains why this trade never accelerates. I'll get to that in a moment. But first, watch what the market actually did. When the flag breaks like this, you normally expect momentum. Sellers step in, price expands, the move continues lower, but instead, the market slowed down. The candles got smaller, momentum disappeared. Minutes passed, then more minutes. 2 hours and 45 minutes later, the trade closed as a loss. Right here. 2 hours later, it closed right here. No collapse, no continuation, just nothing. Just the loss. And this is the detail many traders overlook. The breakdown happened into existing support here. This was the support area here. Right below the entry, there was already structure here in this area. So previous reaction, buys defending the area. So even though the pattern was correct, the market didn't have clean space to move into it. Sellers weren't breaking to open territory here. They were breaking to buyers. And when that happens, follow through becomes much harder. Now, this is where trading becomes dangerous. Because when a trade like this loses, most traders immediately think, I shouldn't have taken it. But that's the wrong conclusion. Because the trade fit my system. The setup was valid. The confirmation was there. The execution followed my rules. Sometimes the market just doesn't follow through, and that's something traders struggle to accept. You can do everything right in trading and still lose. Because trading is not about certainty, it's about probability. And probability doesn't guarantee outcomes. It only tilts the odds. That means good trades will lose and bad trades will sometimes win. That's why the only thing that matters in the long run is process. Professional traders don't judge trades by outcome. They judge trades by execution. Did the trade meet my rules? Did the setup exist? Was the risk controlled? If the answer is yes, then the trade was successful, even if the result was a loss. Because over hundreds of trades, discipline is what creates consistency. This trade met my criteria. Location was correct. The pattern was there. I waited for confirmation, but the market didn't follow through. And that's the cost of doing business with the market. Tomorrow the goal stays the same. Show up, follow the plan, take the trade if it's there, and let the market decide the outcome. So always process over profits and discipline over dopamine. Thanks for watching.